Welcome to today's session on behavioral finance, one of the most important bridges between clean financial theory and the messy reality of how markets actually behave. Traditional finance often assumes that investors are rational. They process information correctly, they make consistent choices, and they control emotions. Behavioral finance challenges that foundation. It treats investors as human decision makers, sometimes disciplined, sometimes not, and it studies the systematic patterns behind their mistakes. The key point is simple. When many investors make similar errors in similar situations, prices can deviate from what standard models would predict. The central difference is the assumption about human behavior. In modern finance models, markets are often described as efficient because investors are assumed to be rational and fast at incorporating information into prices. Behavioral finance removes that assumption. It recognizes that people can be influenced by biases, emotions, and social pressure, and that self-control is not always stable, especially under stress or uncertainty. This helps explain why we sometimes observe price movements, trading behavior, or returns that look abnormal under purely rational frameworks. To understand behavioral finance properly, it helps to organize biases into four major families. Think of this as the structure that will guide the whole topic. 1. Self-deception biases. These are situations where individuals mislead themselves. They may become overly optimistic, overly confident, or believe they have more control than they truly do. The key element here is that the bias comes from the person's own self-perception. 2. Cognitive biases. These come from how the brain processes information. Instead of analyzing everything deeply, the mind uses shortcuts, fast mental rules that simplify complex decisions. These shortcuts can be useful, but in finance, they can also lead to systematic misjudgments. 3. Emotional biases. These are driven by feelings. Fear, regret, attachment, and discomfort with losses can directly shape investment decisions. Emotional biases are especially powerful because they can override logical thinking even when someone understands the correct reasoning. 4. Social biases. These come from the influence of others. People often adjust beliefs and decisions based on what their group is doing or what seems socially accepted. In markets, this can produce collective behaviors that amplify trends. Self-deception biases typically include optimism bias, where outcomes are expected to be better than what is realistically justified. Overconfidence, where individuals overestimate their skill or the quality of their information. Illusion of knowledge, where having more information is confused with having better understanding. And illusion of control, where people believe they can manage outcomes that are largely shaped by uncertainty. In finance, these biases matter because they can lead to aggressive decisions, weak risk assessment, and under-diversification. Cognitive biases are best understood as shortcuts the brain uses to reduce complexity. The brain wants fast decisions, especially under uncertainty, and it often substitutes careful reasoning with simplified thinking. Several cognitive biases are especially relevant in markets. Hindsight bias, where past events feel more predictable after they happen. Self-attribution bias, where success is credited to skill while failure is blamed on external factors. Confirmation bias, where people search for information that supports what they already believe. Anchoring, where early information becomes a reference point that shapes later judgment. Status quo bias, where people resist change even when evidence suggests they should adapt. And framing, where the way information is presented influences decisions even when the underlying facts are the same. Closely related is mental accounting, where individuals organize decisions into separate mental buckets, leading them to ignore the full economic picture. Emotional biases come from the fact that decisions are not made purely in a logical space. Human beings experience psychological discomfort from uncertainty and especially from losses. A key idea here is loss aversion. Losses typically feel more painful than gains feel rewarding. This creates predictable behavior. such as reluctance to accept losses and stronger reactions to negative outcomes than to equivalent positive outcomes. This is also why prospect theory is useful in behavioral finance. It captures the idea that people do not evaluate outcomes symmetrically. Their decision-making changes depending on whether they see themselves in a domain of gains or a domain of losses. Another important emotional bias is the endowment effect, where people value what they already own more highly simply because they own it. This makes objective reassessment difficult. Social bias is about external influence. The market is not just a collection of independent decisions. It is also a social system where beliefs spread. Confidence is contagious, and fear can become collective. The most important social bias in finance is herding. This happens when people follow what others are doing because it feels safer to be wrong together than to be wrong alone. Herding can amplify trends, fuel bubbles, and deepen crashes. Social biases also include preferences and prejudices that influence judgment in areas like evaluation, hiring, and credibility, factors that indirectly shape financial outcomes and institutional behavior. If behavioral biases push prices away from fair value, it sounds like a free opportunity. So why doesn't arbitrage immediately correct everything? Because arbitrage is limited. It has implementation costs, meaning trading and positioning are not free. It has fundamental risk, meaning apparent mispricing may reflect real uncertainty. And it has model risk, meaning the strategy you use to detect mispricing can be wrong or incomplete. So even when mispricing exists, correcting it is neither immediate nor guaranteed. That's the foundation of behavioral finance, a structured understanding of how self-deception, cognition, emotion, and social influence shape market behavior, and why those forces can persist despite rational incentives.